Hi, I was hoping to give you some pointers on problem 3-13. I've had a couple of questions on that. So I'll just sort of take you through a couple little suggestions that I have. For part A, you are to determine what net operating working capital is for the years 2014 and 2013. And I just want you to be sure that when you calculate that, you take your total current assets and you subtract your you're going to subtract your current liabilities, but do not include any notes payable. So, in other words, the company had some notes payable of 5150 in 2013. I'm doing 20, that was in 2013. And so when you subtract current liabilities, don't include that 5150 of those current liabilities. You'll be using the difference in your NOWAC for your free cash flows. So keep that information in front of you when you do your free cash flow statement, which is the second part. And I just want to, I can't remember if I've actually, gone through this with you, but on the income statement in your textbook, they give you the EBIT, the earnings before interest and taxes. And you want that particular figure to include what the tax effect on those earnings would be. And the tax rate is 40%, so you're going to take your EBIT that is shown on the income statement and multiply it by 60% because you want the earnings EBIT after the taxes. And then you will add on the depreciation because we're doing cash flow. And cash flow, you pay taxes from your cash, but depreciation is an expense that does not affect your cash. So you add that back in. Now the other thing that I want to be clear you understand is to calculate capital expenditures. You look at what they had in 2013 in their net property, plant, and equipment, and you look at what they had in 2014 in their net property, plant, and equipment. And if there's an increase, you can see that they have spent some money, spent some capital on some assets. What I want you to keep in mind though is you'll take that change, that increase. You will also though need to add depreciation to that number because you are given a net figure. Now if it didn't say net, if it gave you property, plant, and equipment, and then it showed the accumulated depreciation, you wouldn't have to do that if it separated it out on the balance sheet. But in this case, the net means that they did not separate out the depreciation from the equipment. To explain that, let's say that in 2014 I bought $100,000 worth of equipment. And so that's actually my capital expenditure, $100,000. But on my balance sheet, it shows that I just said net PP&E because I took out $20,000 in depreciation. I depreciated at $20,000, so my equipment had a net book value of $80,000, and that's not actually what I spent. I actually spent $100, so that's why you're going to add back in depreciation to get to this capital expenditures. And then of course, like I said, you've calculated the NOWAC for the 2 years, so you'll just need to add the change in the NOWAC, the difference between these two NOWAC figures. You'll add the change, and that'll bring you to your free cash flow. And so that's part B. Let's see if it looks like part C, if you need any hints. You will just actually be explaining, you can see on the balance sheet that your total stockholders' equity in 2013 was 70,850, and then you see that the stockholders' equity in 2014 is 82,025. What you are in essence doing is just explaining that change. What made it go from 70,850 to 82,025? And really the only reason there's any change is because of the change in retained earnings, which we have talked about, and you should be very clear on that you start out with retained earnings, the beginning balance, and retained earnings is increased by the net income throughout the year, and it's decreased by any dividends the company has paid, and that gives you the ending balance in retained earnings. And so ending balance. And so look at the example of stockholders equity layout, the way the book shows it, and you can sort of use that as a guide. But nothing changed in common stock. The only thing that changed was what happened in retained earnings is what caused this change in balance. So you'll just be showing what that is. For total invested capital, well, I guess I'm ahead of myself. To calculate the economic value added, and that formula is in your book, you're going to take your EBIT after taxes, and you actually did that for your cash flow statement. So you take your EBIT times 60%, because taxes are 40%, so EBIT times 60%. And then the formula says you'll subtract total invested capital times the after-tax percentage cost of capital. And now I know that doesn't mean anything to you, the after-tax percentage cost of capital. We're going to be learning about that later in the semester. It is a given. They gave it to you. So you're going to need to figure out what the total invested capital is. And so total invested capital is simply your notes payable and any other long-term debt and your common equity. That is your total invested capital. And so you'll get those numbers from your balance sheet for 2014, and you'll add those up and you'll multiply it by 10%, and that'll be this side of the equation. And then you'll subtract what you get for that from your EBIT after taxes, and that gives you your economic value added. The last thing that you need to determine is, let's see if I can get a piece of paper that I can get a space on here that I can write on. The last thing you're asked for is the market value added. And the market value added is to show what how much value the marketplace sees in the particular company, because the company has book value, and book value is the number of shares. Well, I'm sorry, I guess I don't need to talk about number of shares at this point, but the book value of equity is just your total stockholders' equity. And you can actually see that on the balance sheet in 2014. Your total stockholders' equity is, I'll just give it to you because it's right there. Then you'll know you're looking at it's 82025. You've done a stockholders equity statement. It should have that on there. That's the book value of the company. And to get the market, if we wanted the book value per share, we would take the total stockholders equity and divide it by the number of outstanding shares, which in this case is 5,000. But the question is, since they want of the whole company, not just per share, then to calculate the market value added, you will take the market value per share and you'll multiply that times the number of shares. And that gives you the market value added, and the difference between this and this, that gives you the market value, I should say. Market value, $20 a share times 5,000. I think it's 5,000 outstanding shares, and so yeah, it's 5,000. And so I'll just, well, you're lucky if you're watching this, I guess. If you have to suffer through listening to me, I'm pretty much showing you the answer to this. So the market value added is just this, the difference between those two. So if we looked at the book value of the company, it is 82,005. Out there in the market, they see that the company has a little more value, and the market value added then would be that number. So I hope that helps you with problem 13.